All right, well, it is 6:03, time to kick off, and it's exciting here this evening. We're going to have a lively discussion on should I buy now and why. And we have Leo from OMG, I need a mortgage. So we're so grateful for you here this evening, and Monica, buyer's agent extraordinaire from Elevation Real Estate. So great, thanks for joining this evening, and let's kick off with December. It's a month that is kind of quieter. There's not a lot going on. Rates have gotten higher, and people are going, whoa, what should I buy now? Well, what are we have a few different things to talk through this evening. Where shall we start, Leo? Where shall we start? Shall we start with the 2-1 program?
Let's start with just a general overview of where the market is at, and because there's so much important and valuable information to share with buyers, so that they're completely informed and prepared going into the process, and so that we've done everything there is to do to make sure that we're in the position for the best possible program and to write the strongest offer possible when the time comes. And this includes a lot of detailed explanations and nuance, all of which is important. But what we want to focus on today in the 30 minutes that we have together is, I'd say, the big picture and answer the most important question on any potential buyer's mind. So let's start with, when is the best time to buy? How do we know when that is? And then second, how to strategize based on what's happening with real estate prices and with mortgage rates, which are the two factors that most significantly impact how well you do on your investment over the long term, because that's really the end goal, right? Long-term gains.
Exactly.
So to kick it off, let's start with what happened in the latter half of this year, in 2022, and then just in recent weeks. That looks like we've entered into, honestly, a unique window of opportunity. As we all know, real estate prices are down, right? This is a good thing. A property that may have sold for 1.5 million last year and required a non-contingent offer and a rush close of escrow, a love letter to the listing agent, maybe your wedding ring, and winning the beauty contest, Eddie.
Promising your firstborn. Yeah. Yeah.
That very same property today, you can close it closer to 1.2 million. And, it's not only the lower price that we can get homes into escrow for, but also how aggressive and intense and competitive the whole experience is. If you ask anyone during the height of the market, it's a really stressful process when you've got 20 offers on a place and have no contingencies. And now you can make an offer with contingencies, and that provides a lot of buyer protection to change their minds if necessary. That's huge. And just writing an offer that you're comfortable with, that isn't rushed, that doesn't have the pressure of dropping contingencies, it really affords buyers the due diligence allowed to ensure
that they would want to have, but
that they would want to have.
The previous market didn't allow for it.
Exactly. And that they're making a decision that's, right for them and their family, and not a rushed one. So prices are more approachable than a year ago, and we all agree that's a good thing.
Well, and the other thing that I don't think a lot of people realize with the pricing is that $1.5 million house, if you were putting 20% down, you had to come up with $300,000 in down payment. If you're buying it for 1.2, you're coming into the picture with $240,000. So a kind of completely different, you're saving $60,000 just in down payment right there.
Absolutely. And that is no small deal. That's not chump change when you're talking about Bay Area real estate at all.
Not at all.
The question, go ahead.
No, go continue on. So go on. So moving on from there.
I'd say the hang up that a lot of people that we hear often is mortgage rates, right? They're higher than they were before. And that hasn't been good news this year for many. And it's why it's less competitive right now. But this is what I want to explain has shifted in just the past couple weeks, that the media either doesn't understand or really just isn't taking proper time to explain. And that's because mortgage rates are based on bond prices, right? The 10-year treasury, not the Fed funds rate. And when you look at Jerome Powell and the Fed raising rates, they are talking about the Fed funds rate. And that's tied to short-term consumer debt. It's tied to your credit cards. It's tied to auto loans, but it does not directly impact mortgage rates. At this point, the single most important factor impacting bond prices is inflation. So the Fed is hiking the Fed funds rate to fight inflation. And when inflation comes down, mortgage rates improves. And here's why we're in a unique window with respect to most people's understanding of what's happening. About 2 weeks ago, we got a CPI report and the market was expecting 8% inflation. And it came in at 7.7%. And that was very good news. It was such good news that bond prices improved dramatically that day. The day the CPI report came in, mortgage bonds had their best day in over 6 months, right? So this all traces back to approximately 6 months ago. And what does that mean now? Big picture. Big picture, the data right now is showing inflation's coming down, albeit slowly, but it's coming down.
Mm-hmm.
And it looks like we likely just saw a peak for mortgage rates. So, and mortgage rates have improved in the past 2 weeks. So unless we get some really unexpected news on inflation, and the next CPI reading is December 13th, so in just a few days, it's likely that we've seen the peak. And the reason that most people won't realize this, unless they're really watching bond yields closely, is because the Fed is still in the process of hiking the Fed funds rate. So it's kind of doing a dance, right? It's currently at 4%. And the Fed has told us we are going to hike the Fed funds rate to 5%. So the interest rate environment, what does that mean? It means that it likely looks like this. The Fed continues to hike the Fed funds rate, and that's what the headlines will cover. Meanwhile, under the radar, as inflation is coming down, the mortgage rates are likely to improve. And that's why the next few months in particular, I'm talking December and the early months of 2023, are really a unique window, because home prices are lower, and that's likely to remain the case, right? And you can write an offer now with contingencies in a much less competitive environment. And we are seeing a trend, and it's likely to continue, that the mortgage rates will be improving despite the fact that the headlines are going to create a narrative that rates are increasing. But that's the Fed funds rate. It's not mortgage rate. And in the battle to calm inflation, it's likely to actually improve mortgage rates in the near future.
And it leads into what we have been saying as an advantage, because you can use this kind of stormy weather, where before, where all the boats were shooting by you in calm waters, now it's a little stormy and there's not as many boats in the water. You want to marry the property and get into a long-term relationship with the property, but get into a short-term relationship with your mortgage, because you are going to be dumping your mortgage.
Yes.
At a certain, probably within 2, maybe 3 years, right?
Totally. And as you mentioned, a couple of extra factors. We're talking about lower down payments in this environment. And another really important one in a city like San Francisco, property taxes are based on purchase price. So if you're getting into the property at a lower purchase price, that means lower property taxes for the life of your ownership of the property.
Yeah.
Well, if you bought 9 months ago at the peak of the market, that's the purchase price, and that's where the property taxes would remain throughout, the span of ownership. So we're seeing, more savings
the
there.
the other one that kind of really bends my mind, which is kind of just to understand it, is there are people who couldn't qualify to purchase a few months ago because of the pricing and what they would need on reserve and the competitiveness, who actually now qualify because the down payment they need is not as big. And therefore they have the reserves on the back end to qualify for the mortgage, and they're able to go in and, you know, make an offer on a property that a year ago they wouldn't have been able to buy.
I'm doing a webinar. I'm doing the class now. So this is I can't. Yeah. Okay. Oh yeah. I'm going to take that out. Yeah, I can take that out. Thanks.
All right. So
Yeah.
everything okay there, Renata? If you could put yourself on mute, that would be great.
Well, you know, ruin the webinar, so I have to. I'm on it now.
There we go. Cool. So so that's amazing. Like, it's just, that one is a real mind bender for me, that you wouldn't think with the opportunity that arises just in the fact that you don't have to promise your firstborn to be able to get a piece of property. So
Right. And I think in large part, right, what makes people feel hesitant is because when you read the headlines, it's all saying, you know, the Fed is going to increasingly hike interest rates. And there's a little bit of a misconception that that's directly tied to mortgage rates. But beyond that, it really begs the conversation of what's going to happen with mortgage rates, you know, in the near future. And a report that quietly has slipped under the radar that isn't getting the headline attention that I would say it deserves is the Mortgage Bankers Association projected that the average 30-year fix in 2023 will be approximately 5.4%. So digging deep into the inflation data, you know, our confidence is increasing that that is likely to happen. And that means that even though rates went up drastically over the past year, they're now coming down. And this is a great window where it hasn't really baked into the market yet that that's the case. So prices are low, competition is low, you can still make offers with contingencies. And so when we get you into that home at a lower purchase price, you'll then be in a great position to refinance when those rates do come down, you know, into 5.4 land or whatever it might be in 2023. It's a temporary situation, and there's equity baked in too, because when rates come down, San Francisco is a desirable place to live. I bet on this place, you know, 100 times out of 100. Anytime there's been an opportunity to buy in at a discount, you can look at times when there have been earthquakes, for example, right after '89. It didn't last that long. The dip in housing prices didn't last for more than a year or a couple of years. And I see this as a really unique opportunity to capture some equity in the Bay Area housing market.
yes, every time there's one of these kind of moments where you can buy without competition or you can buy with a discount, as long as you're a person who is thinking long term, you know, it's not, this is not a short term, hey, in 12 months or 18 months, everything's going to be hunky dory. It's, you know, something that 5-7 years from now, you look like a genius.
Totally. And you know, along those lines, right? If it is, if it's a long-term relationship, then you absolutely will have the opportunities to refinance. If it's something shorter term, you know, another great strategy that actually applies to long-term or short-term is what you mentioned before, a 2-1 buy down. And that's essentially where a borrower pays points up front in exchange for lowering the rate 2 percentage points in year 1 of the loan, and then 1% in year 2. And then year 3, you know, it's the regular market note rate, as opposed to an adjustable rate mortgage, right? Where if you're taking the risk of riding into the adjustable, I mean, no one has a crystal ball, but we don't see that as particularly advisable. especially when you're talking about like a 3-year or a 5-year arm. They're
The
just
pricing doesn't seem to make sense on them. Like the pricing on some of those just doesn't really kind of bode well. We love the 2-1 because the 2-1, one of the things about it is doesn't the seller has to be the one contributing the cost of the discount. So it's like, hey, seller, we have a buyer who is motivated and likes your property, but we need you to participate in this program for us to be able to make this happen. And it really allows somebody to get into that long-term relationship with the property where they marry the property and they make it theirs, but they're in a temporary relationship with the loan because they get a 2% discount on it the first year, a 1% discount the second year, and then it goes to the fixed rate in year 3, which is by all kind of analysis, the large majority of economists all seem to be, the worst doomsday people are kind of talking about 2025, 2026. So, like that year 3 gets us to 2026.
And that's exactly why you work with such strong buyer's agents like you guys, like you, Eddie, like you, Monica, like you, Haley, because having a realtor who's able to advocate for you to the sellers and say, look, this is where we can really come together and find a great deal. The buyer is going to be able to have a more affordable monthly payment. We won't have to drop the purchase price quite as much. We know that this is a market where that negotiation strategy can really be a win-win for both sides. So I think the one other topic that's important to cover is for the people who may have previously doubted if they could get into the market right now, right? Because the lower purchase prices are good. But another big advantage that's going to kick off in a few weeks is for first-time home buyers whose greatest hurdle was the down payment. And that's in addition to the lower prices, that's because the 2023 conforming loan limits, they were just officially announced, and San Francisco is increasing to over $1 million, to $1 million,
nearly $1.1 million, nearly like $1.089 million. It's incredible.
That is incredible. And it's way easier to get into conforming loans with just 10% down, even 5% down sometimes. And that means that San Francisco properties, which were 1.5 million just last year, now 1.2, can be gotten into for 10% down. I mean, it's 20% on most jumbo. And that is a really significant difference when it comes to how much skin you have to have in the game up front. So I think that's really important for all buyers to know. And
it speaks to the buyer that wouldn't have qualified a year ago.
Exactly.
Hey, I can get into a conforming loan in 2023, because just to the significance of this, we're going from the previous conforming loan balance of what, 729 or 749?
In San Francisco, it was 880, 200, but right, it's a big jump.
It's a big jump.
It's a really, really significant jump. And it factors back into why this is really unique timing, because people will catch wind of this, I believe, as 2023, starts to get in full swing. And there's a really simple, investment strategy by, probably the greatest mind in real estate investment, Warren Buffett. And that's when people are greedy, be scared. And when people are scared, be greedy. And right now the market is acting scared and trying to time the bottom, saying, no, I see projections that'll keep coming down. And I would encourage everyone to think about this, right? Like if you can narrow it down to approximately 3 to 6 months in real estate, that's nailing it. If you told anyone in 1990 what their house would be worth in 95 and then 2000 and then now, I mean, I think anyone who bought back then is feeling pretty good in San Francisco. And
Mhm.
we're watching declines of 10% more in some cases. I just, to me, that's really glaring opportunity. And I'm more than happy to chat about how to approach it to any interested buyers. Even if you're on the fence, I think now is a really great time to know what you can afford.
Perfect.
And likewise, there are reports of less properties on the market, but there are always sellers that are needing to sell. Buyers who are interested, this is a great opportunity, and it's bringing the two sides together and to meet a meeting of the minds, so to speak, and trying to make something happen. So there is an opportunity there, as well as getting in for a good rate and having that long-term gain in the end.
I completely agree.
Yeah, there's nothing, it's kind of like you have to find where the advantage is for you, and there's that great expression: if yesterday was the best day to buy a piece of real estate, when is the best time again? And that's now, because yesterday is only around the corner. And it's, as long as you're a long-term in your viewpoint, we're not into this fast trading speed scenario, because that's a mug's game. So the true benefits of a smart decision in real estate are a decision that's made with longevity in mind.
I think that's super well said. I mean, real estate is a long-term wealth creation strategy, and there might be short-term gains still, especially when buying in a softened market. So I
and extraordinarily enough, I think I was looking at a statistic the other day that the net worth of the individual in the US who is a renter, and compared to somebody who is a property owner, is on average, the difference is 13x. So 13 times the renter to the property owner, which is kind of a mountain of a difference.
It's a mountain of a difference.
And this is an opportunity for somebody to climb the mountain.
Yeah.
Awesome. Well, if we're looking for you, Leo, how do we find you?
I'm very easy to find. I'm typically on Union Street in my office, or if you want to send me an email, it's leo@omglenders.com, or call me anytime. It's 415-317-4523. Perfect. Yeah.
And then Monica, if anybody's looking for us and for any for expert advice on real estate, how do they find us?
They can find us at elevationrealestate.com. And also, if they'd like to follow us on Instagram, we're at elevationsf. Come back and have a look there, and you'll see some highlights from today as well.
Perfect. And then just if anybody has any questions, you can throw it in the chat. And otherwise, I think this has been a awesome 30 minutes, very educational, and appreciate always the depth of knowledge that you bring to this conversation, Leo. Thank you. And
anytime.
It was tremendous, and we'll see you guys soon.
Sounds good. Always a pleasure to see you all.